Now, the goal of product development in the portfolio management landscape is to help clients achieve the right development pathway for their investments. Joining us from Cape Town is Dawie De Villiers. He is CEO of Sanlam Structured Investments. Dawie, thanks for your time. You write here that sporting a Ponzi or a pyramid scheme is actually easy, and yet year in, year out, we've got people that are caught out by these schemes. Do we put that down just to greed, or do we say actually people are gullible, or is it because actually it may be harder than you, the expert, says?
I think greed is a big part of it, but I think that's almost too easy to say it's just greed and people are just greedy for money. Obviously people want high returns and people want good returns on their investments. But I think a part of it is also that people just don't have enough money. They haven't saved enough when they get to retirement. A lot of these people that are caught in these Ponzi schemes are people that are using their retirement money and they just want it to last a little bit longer. So it's probably also people that just don't have enough and they're looking for an out to kind of increase their money.
Yeah, so let's talk about some of the things to look out for in terms of watching out for these kind of things.
Yeah, I think the first thing is you must definitely invest with a reputable institution, an institution that's at least registered with the FSB, and then the person that you work with, the advisor or the FIA that you work with and that gives you advice, that is registered. I think it's very important to work through. There's a lot of regulation now with FICE and all these new regulations coming in, that you have to be registered and you have to write all these exams to give proper advice. So it's important to follow those guidelines and not just invest with a friend or with somebody that you know that isn't part of these proper guidelines.
Yeah, but isn't it also part perhaps because there's not enough education for people, particularly as you mentioned, who are retiring, to warn them of these kind of things and also to educate them about how to invest wisely. I mean, we are starting this year at CNBC Africa. We've got a number of programs that look at investments and trying to teach people how to invest. But I would imagine for the older ones, as you say, you're under pressure, you're retiring, you need the money.
Exactly. I think firstly these programs of yours and right through South Africa that people are starting to educate people is very important. We find I work with individuals on a day-to-day basis, especially pensioners, and there's a very limited knowledge about the markets, and it's actually almost people are scared. People are scared of the market, they're scared about products, and therefore they don't want to know more and they don't ask. And that leads them into problems, making wrong decisions. Even when they invest in good, reputable products, they make mistakes and they invest in the wrong type of products because they're scared. So this education, and it won't have the necessary effect on day one, but we'll have to keep at it because over time and over generations, hopefully we'll educate people financially a bit more.
Yeah, but you'd imagine, with the outperformance of the JSE and the headlines blaring out from us, from the print media, talking about the JSE being at a record, you'd imagine it's easier to attract people to the regulated market where at least the returns are consistent and also, transparent. Just in terms of where you are now, when you advise clients, what do you tell them about perhaps where they should be putting their money?
Yeah, it's interesting. The feedback that I get from clients, especially after all this Ponzi schemes like the Herman Pretorius thing that happened now again, and also the volatility in the market in the recent past. I know this year has been a good year for equities and a good, solid, stable year for equities and for the markets in general. But people are still scared. The negative effects of the equity market and of markets in general and of things that happen through fraud stays with people a lot longer than a short-term recovery in the market. So people are still very scared and they want certainty with their investments. So we see a demand for certainty, and people are almost kind of going back to the cash-like investment. So part of the education is almost to say to people, you need real returns, you need positive returns beating inflation to actually survive in the longer run and to get a proper return on your investments. Otherwise, you're going backwards. Yeah. So that's almost part of the education.
Yeah. Let's go back to that education again. Where should that come from? Should that come from the industry, or is that perhaps something that should be coming from the government, particularly because you do want people to believe that this is the right thing to do?
Yeah. That is a very important point. We as the industry try and to give education, but a lot of the times it's seen as almost selling and pushing product rather than educating. So I think it must be a combination. The industry can't stand backwards and have to do its part. But initiatives from government would go a very long way in terms of creating the awareness in the market that saving is important, what type of saving, what type of risk should we look at, and also to regulate a little bit in terms of getting simpler products out there, lower costs, that is easier for people to invest in.
Yeah, but what's your sense in terms of the industry? And then I'm asking you here to mark your colleagues. Are you guys doing enough, or perhaps there is more that you need to do, not as individuals, Sanlam or etc., but actually as an industry,
Yes.
so that it's the sting of saying you're trying to sell a product is taken out and people receive the education in good faith?
Yeah, I think we as an industry has evolved quite a bit over the last year or two, especially in terms of costs. There was high cost in the past in products. That's come down a lot. The way that people that sell the policies and the products are incentivized has come down a lot. So I think from that point of view, the industry is regulating itself to an extent, because we know that's the way that it should be, and that's the way that it should be for the investors. So the industry has done its part in that sense. But it will evolve over time. It has to go over time. And I think your previous speaker also mentioned lower cost type products. I think there are innovative products and exciting products that will cost a little bit more, but there must be a way for people to access cheaper products like the trackers or the ETFs,
Yeah.
which are cheaper but gives you access to the market. And we must educate the market about those things that actually do exist and that are there, and that should be a lot cheaper to access, but we must actually make it create the awareness that those are there.
Yeah, the skeptics will say, of course, the industry is favored by higher prices because, the commissions come in a little better. But perhaps that's a debate that we don't want to go into today. Let's talk about 2013. Given the history that we've got out of 2012, we've got an uncertain world. We've got growth slowing in the US. We've growth slowing in Europe. We know actually there's no growth in Europe. They're in recession. China is coming down. So what kind of products? We don't want to party any particular product, but what kind of product then
Yes.
do investors look at in an environment that I've just described?
Yeah, I think the first thing is important to notice, and I've already said it, but you can't say it enough, is returns are low. We're talking single-digit type returns that we see going forward, and interest rates are very low. So it's very, very difficult to beat inflation over the long run, given conservative type investment. So you must take a little bit of risk. There must be some equity in the portfolios, and people are starting to realize that. But the general trend of the investors in the last year has been to go more conservative, to take their money out of more risky investments like pure equity funds and taking it to balanced funds, or even to more conservative funds with lower equity participation, which I think is again something that we see. We see investors generally making the mistakes and going into and out of investments at the wrong time. So we must have investors looking at real returns and looking at as low as possible risk, but given real returns.
Yeah, if I can put words in your mouth.
The type of products. Sorry, the type of products that we're seeing is lower equity participation, but I think what the market is trying to develop is products that gives them more equity participation but less volatility. And we're seeing in the wholesale market, you're seeing all of these type of products that give smoothing and all of that, because it can be done on the balance sheets. But to give access, you need products in the unit trust environment, as I said, that are cheaper and that is accessible to the retail investor. And I think more and more we'll see products that gives more smoothing and more protection and less volatility, but still the real returns.